As the United States markets are currently closed for the holiday ahead of the weekend, Datavault AI Inc., trading under the ticker symbol DVLT on the NASDAQ exchange, finished its most recent live session on July 2, 2026 at a closing price of $0.3841 per share, representing a standard trading session drop of 4.90%. When you scan the daily activity for this stock on popular platforms, the superficial headline might tempt you to think this micro-cap asset is just another volatile penny stock fading into obscurity. But look past the surface drop, and you will discover a completely unexpected twist that standard screeners miss. Just hours ago, the company finalized details to act as the official core infrastructure provider for a massive digital framework linked to real-world asset tokenization in the commodity sector, specifically a joint asset vehicle intended to reach up to $700 million in total scope. This single arrangement could theoretically channel up to $62 million in technology service revenue straight to their balance sheet, completely rewriting their near-term liquidity parameters. This sudden disconnect between a collapsing equity price and an expanding massive commercial pipe creates a fascinating puzzle for retail investors who handle their own individual brokerage accounts. The collective expectation surrounding Datavault AI Inc. is rooted in deep skepticism. Most market participants looking at microcap technology equities believe that small firms claiming to combine blockchain settlement with data networks are structurally flawed, highly dilutive, and prone to rapid cash burn. Retail investors who manage their capital through online investing tools see a stock that collapsed from a 52-week high of $4.10 down to the low 30-cent range, assuming the company is running out of options. The reality, however, is much more complex and heavily intertwined with institutional infrastructure plays that are completely invisible if you only glance at a basic chart on standard investing sites. While the general sentiment paints the firm as a speculative shell, institutional actors are evaluating the company's underlying asset tokenization stack for heavy industrial applications, including critical mineral supply chains. This massive contrast between public perception and actual enterprise pilot programs forces us to re-examine the core structural mechanics driving the stock right now. To truly understand what is happening behind the scenes, we have to look closely at the immediate trading patterns, daily volume fluctuations, and the technical breakdown that occurred during the latest market sessions. During the last trading day, the equity experienced heavy localized volume with over 34 million shares changing hands, which is remarkably high compared to its historical baseline. The intraday tape showed an opening price of $0.4099, pushing to an early session high of $4.567 as short-term traders reacted to the initial project announcements, before massive systemic selling pressure dragged the asset down to an intraday low of $0.3838 just before the closing bell. This level of intense volatility points to an aggressive battle between retail accumulation on low-cost applications and institutional distribution or algorithmic short selling. When individuals practice self-investing through advanced interfaces, they often encounter these sudden traps where positive press releases are immediately met with aggressive block selling, leaving late buyers holding bags at the local top. This sell-in volume cannot be viewed in isolation. It must be framed within the broader macroeconomic landscape and sector-specific shifts. Right now, small-cap tech is facing severe liquidity constraints as aggregate capital flows away from speculative small enterprises and moves steadily toward mega-cap defensive equities. Major asset managers handling large index allocations are adjusting their models, which indirectly puts pressure on microcaps that rely heavily on continuous equity financing. Furthermore, the recent internal governance changes at the firm, including the transition of their independent auditing firm, BPM LLP, have triggered compliance alarms across various quantitative trading desks. When a small technology firm loses its auditor right in the middle of launching a major commercial framework, institutional risk models automatically flag the asset, triggering systematic liquidations regardless of the underlying product potential. This structural overhang explains why the equity failed to hold its morning gains, as algorithmic selling models prioritized compliance risk over the raw mathematics of the new $700 million platform framework. If we look at how retail traders are interacting with this asset, the data reveals significant positioning clusters across major consumer financial platforms. A large portion of the daily retail volume is originating from individuals using the popular Robinhood app, where features like fractional shares and zero commission structures make it incredibly easy to speculate on stocks trading under $1. These retail participants are tracking the stock's massive upside potential, often referencing lone institutional analyst targets that project a fair value of $3, representing a massive theoretical surge from current levels. However, many of these retail accounts fail to calculate the true structural implications of the company's capital structure. With over 855 million shares outstanding, the float is exceptionally diluted, meaning that any upward price movement requires an enormous amount of sustained capital to maintain momentum, a reality that often shocks younger investors who use basic automated features like Schwab Intelligent Portfolios or generic robo-advisors that naturally filter out highly volatile microcap equities due to strict risk parameters. Let us shift our focus for a moment to the structural reality of the company's business model and past financial history to see how they arrived at this critical juncture. Originally operating under a different corporate structure before rebranding in early 2025, the firm has spent years trying to monetize its proprietary data valuation and information exchange architectures. The foundational business model is built around giving enterprises the ability to capture, secure, and assign clear quantitative values to their internal data assets using automated scoring systems, which can then be secured via distributed ledger technology. They also operate a specialized wireless audio connectivity segment via their WISA Technologies unit, which recently announced product integrations for home theater systems in large international consumer markets like China. Their past financial reports, however, paint a picture of an enterprise struggling to bridge the gap between technical execution and consistent high-margin software revenues. For example, in their first quarter financial results for 2026, the company recorded revenue of $3.42 million, which, while showing a technical beat against depressed consensus expectations, still highlighted a steep net loss, carrying an earnings per share figure of negative $0.96 on a trailing 12-month basis. This chronic lack of profitability is exactly why the company has had to rely so heavily on continuous private placements and dilutive equity financing rounds to maintain its working capital. Although executive management has consistently pointed to a solid liquidity buffer of roughly $250 million in total resources to fund their immediate operational expansion, the market remains deeply unconvinced about the long-term sustainability of their spending habits. The firm's quarterly operating expenses have regularly climbed, driven by heavy research and development costs associated with rolling out their data infrastructure across multiple target cities, along with the complex operational integration of their recent corporate acquisitions. For someone analyzing this setup through a premium individual brokerage platform, the central question is whether these capital outlays will finally yield scalable, recurring software fees, or if the business will remain permanently dependent on creating highly speculative commercial partnerships to justify its public valuation. Comment below how many shares of this stock you currently hold, or if you are completely avoiding microcap technology assets in this high-rate environment. Gathering community data gives us a clearer picture of where retail sentiment actually sits versus institutional positioning. Looking forward, the future valuation of this enterprise will be entirely determined by the tension between their massive commercial expectations and the harsh reality of operational execution. The primary upcoming catalyst is the formalization of their proposed partnership with Patriot Strategic Metals to build the tokenized materials platform. If this framework transitions from a preliminary non-binding agreement into a legally binding contract, the guaranteed technology allocation could radically alter the company's cash flow statement, providing a sudden influx of non-dilutive capital that would instantly resolve their immediate listing compliance pressures. Additionally, the company is heavily reliant on legislative shifts, particularly pending domestic regulatory acts like the Clarity Act, which could establish a standardized legal framework for digital assets and real-world asset tokenization, potentially opening the floodgates for larger institutional partners to utilize their patented data exchanges without facing regulatory blowback. Conversely, the downside risks are remarkably steep and should not be ignored by anyone engaged in online investing. If the proposed metals platform